2 weeks away from a Federal Reserve rate decision, 2 weeks tomorrow. Lindsey Piegza of Stifel writing the Fed should be on the verge of a pause in policy adjustment. While Fed officials are anxious to provide less firm policy after 14 months at peak levels, the risk of unwinding policy too soon or too fast is a reignition of inflationary pressures and a reversal of the progress already made. Lindsey joins us now for more. Lindsey, good morning.
Good morning. Thank you for having me.
What did you make of Governor Waller yesterday?
Well, I think this is really the general theme of what we're hearing from Fed officials as of late. They're setting the bar noticeably higher for a potential pause, saying it's no longer about a strong or solid economy, but it's about the data outperforming expectations. Or as we heard from Goolsbee last week, it's about a potential economy overheating. So I do think that the Fed is gearing up, to push through a third round rate cut in December. But as we turn the calendar page next year, if the data remains as strong as it is, if the economy continues to prove remarkably solid, as Chairman Powell described it, I do think they're going to be backed into a corner and forced to take a potential policy pause.
I've got to ask you what kind of data would change the conversation. I think Governor Waller compared fighting inflation to a UFC fight in the octagon yesterday. I'm not sure how helpful that is for people or not. What kind of number would it take?
Well, remember, looking out to Friday's non-farm payroll reports, the strength is going to be outsized, or at least we expect that. But that's going to be offsetting the weakness that we saw the month prior. So even a number 220,000, I don't think that's going to be enough to deter the Fed from pushing through that December rate cut.
MMA, I think it was. It was in
martial arts.
Yes, I think it was
in UFC.
in UFC. Thank you. That's good. I'm still trying to wrap my head around the hard words that he had about getting inflation in a headlock and driving it to the ground in the last round to the actual, okay, we're still going to cut rates. I mean, it sort of raises this question. How much do you think that they are still underestimating the inflationary pressure in an economy where it's not about the labor market as much anymore as the inflation read that we get the following week?
Well, that's exactly right. The concern of this emerging weakness in the labor market prompted that outsized 50 basis point cut in September. We didn't see that weakness come to fruition, and so then they followed through with another 25 simply because I think they were worried about having egg on their face or admitting a policy error, being too aggressive the month prior. But to your point, they don't have inflation in a chokehold. They need to keep their eye on the ball because the past several months, inflation has really moved to the sideways with no further improvement to speak of. So at this point, yes, we have made discernible progress down from peak levels, but we still have that last mile to go, and now is not the time for the Fed to give up on that goal.
John was asking earlier about this discussion around neutral rate, saying that there is quite a ways to go before you actually get to truly a neutral rate. At the same time, that some of us are struggling to see the restrictiveness in terms of rates, other than a couple of pockets for a couple of segments of the population. Do you see us as anywhere close to restrictive?
So that's a good distinction that we need to be made, because right now policy still is very firm, and changing conditions, further improvement in disinflation does warrant less firm policy as we move towards neutral and the data normalize. But we need to do so at a very slow and tempered pace. So I don't think the question is, do we justify further rate cuts? I do see further rate cuts on the horizon, but the pathway, the pace to that lower level of Fed funds needs to be very controlled as to not overshoot or undermine the progress that we've already seen made on the inflation front.
So how many cuts can you actually see next year when they have to recalibrate for potentially tariffs, tax cuts, and a whole host of new policies coming out of Washington?
Well, assuming they do push through the December cut, that's the third round cut, I see 3 more cuts in 25 on a quarterly basis. So 1 25 basis point cut per quarter, getting us to 3 3/4 by the third quarter. And I think that's a reasonable neutral level. Now, of course, some policy issues may limit the downside potential if we do see tariffs or sizable tax cuts lead to further inflationary pressures, but that's a big question mark. The inflationary pressures that we're assuming under those scenarios could very easily be offset if we saw sizable reductions in government spending or other areas. And so it still is questionable, the net outcome from the incoming administration. But right now, ceteris paribus, I do expect 3 additional rate cuts next year, taking us to a neutral rate of about 3.75.
If we get the December cut, how hawkish do you think the tone might be from Powell? Because he's looking into a lot of unknowns for next year.
How much more hawkish, you mean? At this point, he's talking about a remarkably solid economy, remarkably strong labor market. So he's really laid the groundwork for a pretty solid assessment of current conditions. Again, keeping that door wide open for a near-term policy pause as soon as they deem it appropriate. And again, if December data comes in within expectations, I think the Fed continues to follow through with a third-round cut. But they've already set the table for a potential pause given the strength that we're seeing in the consumer, in business investment, even in housing, and that sticky nature of inflation.